Welcome to today's episode where we're joined by Gary Reynolds, Chief Investment Officer at Courtiers. Gary's recently published two thought-provoking pieces exploring the evolving role of UK government bonds, particularly long-dated gilts, in modern portfolios. With over 125 years of market data at his fingertips and a career that spans multiple economic cycles, Gary brings a unique perspective to the intersection of macroeconomics, behavioural finance and fixed income strategy. So, let's dive in.
Hi Gary. So your article from August, It's Time to Look at Long-Dated Bonds. What prompted your shift from equity preference to a more bond-inclusive view?
Oh, good point. I think what got me going was that we have been so negative bonds for so long, and bonds are important. They're an important asset for people that want to invest safely over a number of years. You know, government bonds are probably one of the oldest forms of investment you can probably have, and we have just been anti them for years, which has paid off handsomely, particularly in 2022. And suddenly I realised that yields had got up to quite high levels, and I thought, well, it's about time we started looking at them again. And I like looking at historical data, and God bless the Bank of England. You know, you've got centuries of great data, so you can track these sort of government bonds, UK government bonds, all the way back to 1700.
Sounds like a passion project that turned into
something
more.
I was very lucky, you know. If you like doing that type of thing, this is the best job in the world. So yeah, it's good. It's good fun.
One of the key points, Gary, in your research note is term premium, defined as the additional yield for holding longer maturities.
Yeah.
How should investors weigh the term premium against inflation risk today?
Just to clarify what term premium means, it does include inflation risk. But if you lend me money, let's say you're going to lend me £10,000 for 6 months, you can assess, you know, what my credit worthiness is and whether I'm going to give you the money back in 6 months. But if you're going to lend it me for 20 years, a lot can happen in 20 years. So you're going to want to lend that money to me at a higher rate over 20 years than you do over 6 months. And what will guide you as to how much you charge me is how risky you think I am. Now with bonds, because fixed interest bonds, they give you back exactly the capital that they say they're going to give you back and exactly the same interest every year. You've got a risk not only of not getting that money back or the interest payments, but you've got a risk that inflation means when you do get that money back, it doesn't buy as much as it did when you invested in the first place.
Sure.
Now, you know, all investors in government bonds assume there's going to be some inflation, but it's the level of inflation that really concerns them. If you go back 5 years to 2020, when we're in the throes of the pandemic, 10-year gilt yields in this country are virtually zero. You're getting next to nothing. And that's because the expectation is that there's not going to be any inflation in the short term, and therefore no one wants a term premium. And because a lot of UK pension funds are in big deficits, trustees are being forced down the path of buying government bonds to show that they can stabilise their liabilities, which means you had a big market, a lot of buyers for bonds at exorbitant prices and very little, no term premium. And so when it went wrong, it went horribly wrong when things adjusted and long-dated gilts dropped 40% in 2022. What's different today is that you can buy sort of 25-year bonds in the UK about 5.5% yield. So if you assume that you need to have a rate over and above inflation, we make an assumption what inflation is going to be. If we trust the Bank of England and the government, we think 2%. But that would mean that you're getting a real return over and above inflation of 3%. So if you like, there's kind of your term premium versus inflation. But that's reasonable. Because when you look at the long-term data, inflation in the UK actually averages just below 2% per annum. So we're not actually as high an inflationary economy as everybody thinks. But everybody thinks back to the the 1970s when inflation got over 20%. And for most people, no doubt you two around this table, that's history. For me, it was current affairs at one stage. So that's what spooks people. And there's this worry that the UK, somehow outside of Brexit, is a bit of a basket case. And so you get paid better on UK bonds than you do on most other developed economy bonds at the moment.
You discuss how in the piece, you discuss how the Bank of England base interest rate drives gilt yields.
Yeah.
Why is there such a correlation?
There are two reasons for it. Well, first, because if the Bank of England pushes interest rates up and then rates in bank deposits go up, it's more attractive to hold money short term than it is long term. So gilts become less attractive when interest rates get very high. The second reason is because the Bank of England tends to push rates up when inflation is coming into the system, and gilt holders don't like inflation.
Gary, you mentioned the UK seen as a basket case outside of Brexit. Like all the news in the media, government debt, all the scaremongering, how's the media contributing to the situation? Are they providing comfort for people?
Do you think the media is designed to make people feel comfortable, Leo? And I don't think nice headlines sell papers or drive people into listening to podcasts or watching clips on TikTok.
Unfortunately, not.
It's the sensational stuff that does it.
But how much of this correlates with the real world when you're at the desk and you're putting your years of experience to use?
It does correlate because if bad news is out there, bad news is out there, and it gets picked up. But the truth is, it gets overhyped. Generally, the good is never as good as everybody says it is, and the bad isn't as bad as everybody says it is either. So let's take the UK. So everybody's saying it is a basket case. I've already said that interest rates in the UK, long-term interest rates, are higher than they are in the other developed countries. So they're higher than most of our European partners, certainly higher in the US and even Italy. And so you've got that situation at the moment. And that's because there's a worry that we're not doing great outside of Brexit and we're struggling. We're not the only country that's struggling. France is having a rough time, so is Germany. So don't think for 1 minute that we're particularly unique. And we've been through bad patches in the past as well. But everybody's panicking at the moment. And the key headline is debt to GDP. Government debt to GDP has gone over 100%. Well, so what? So what? It was 94, 95% average over the last 300 plus years. And it hit its peak, 1946, 259%, and came down significantly afterwards. So, the idea being that if you've got too much debt, this is the really what people are postulating. If you've got too much debt, if debt to GDP is going up, then interest rates are going to go up as well because nobody wants to buy these bonds. They're getting very spooked. In actual fact, there's hardly any long-term correlation between debt to GDP in the UK and the level of interest rates. And if there is any, it's the reverse. So it's a negative correlation. And I'll give you a very good example of what proves this. So 1946, post-World War II, debt to GDP in this country hits an all-time high that it's not hit until last one was after the Napoleonic Wars. It gets to 259% of GDP in the UK. Interest rates at that time, around 2.5%. 1974, debt to GDP, 53%. Interest rates, around 15.25%.
This is demonstrated in your charts.
Yeah, I put it in there just to show. There's a scatter chart in there, and you can see there's a negative relationship with it.
You're talking about your second piece that we put out. Yeah.
Yes.
Yeah.
The one that's sort of looking at those bonds, and it's if anybody listening to this wants any more data on it, I can always provide it if they're.
And the summaries on the website as well with the articles themselves, if anybody would like to read those.
Yeah. But you see the point. But that's completely contrary to the way everybody's being spooked. All debt to GDP is going up, therefore interest rates are bad. Well, they're already relatively high. They're about 1%, just under above their all-time long-term average. So you're not getting paid badly on government bonds at the moment. And one of the beautiful things with government bonds is that they tend to be defensive in an equity collapse. Now, we've not had that luxury of having that sort of hedge in the portfolios for a long time now, particularly for more cautious investors. Generally, you'd have a higher amount in bonds. We've had to find hedges in other ways to hedge equity risk out a bit. But it's quite reassuring to be able to get back to holding some long-dated bonds and getting paid for holding them, which you weren't in 2020.
What sort of timescales are you expecting for us to see some effect on the decisions that you make today with the team?
Well, I think what's good is that it gives us the prospect of getting a better. Let's take Cautious. Cautious can't hold more than 60% in equities.
A cautious fund.
A cautious fund can't hold more than 60% in equities. So we've got the other 40% has got to go in lower risk assets. And in practice, we hardly ever get. You don't hold 60 because you can't go above it. So you're holding a lower amount, probably 55% would be typical. So you've got to find another 45% that's got to go into other assets to dampen things down. The beauty with government bonds is that they are very liquid, very easy to hold. And when you get a crisis, governments tend to chop interest rates, and that's a positive environment for bonds, which is why when base rate was down to 0.25%, bonds were doing so very, very well. So that's I find that really exciting that we can start buying longer dated bonds again. But what it means for the investor is we get a chance of getting a slightly better overall return over the next 5-10 years than we could than we were looking at if you go back to sort of the late 20-teens, early 2020s. So that makes things a bit more interesting.
Just in terms of, you were talking about like the correlation between debt to GDP and interest rates. In the piece, you talk a lot about there not being a correlation, but there's obviously a relationship. Can you kind of explain the difference between those two?
Some things in life you get really good correlations. So when the sun shines, people sell more ice creams.
Yes.
The little shop round in Henley wasn't selling any ice creams yesterday because it was a bit cold and wet. So there's a clear correlation between sunshine and ice cream sales. With bonds, there is no real correlation between debt to GDP and long-dated interest rates. People think there is, people think there should be, but actually there isn't.
And why do people think that? Because there's more debt that they've got to increase interest rates to get more back?
Yeah, well, they think of it because they try and look at the government like a household. You go back to that example when I said if you were lending me £10,000 over 6 months, it'd be different than if it was over 20 years. Then what you're also concerned with is what's my income stream? What assets have I got? Am I going to be okay? But I can't print money, but the UK government can print money. So it doesn't have to default. It just prints more cash. The only time countries get into problem is if they can't control their own currency. And generally that means they've borrowed in a different currency. So a lot of them, if you look at the South American debt crisis back sort of 20, 30 years ago, those governments had borrowed in dollars. Their currency was collapsing, which meant they had to generate more of their own currency to pay dollars back.
Sure.
So if you control your own currency, as the Americans do, as Europe does, as Japan does, as we do, then it's a different situation altogether. And what people don't understand, and this comes on to the other article that I'd issued with regard to sectoral balances, is everybody's saying at the moment, GDP, debt to GDP, we're running a persistent deficit of about 5-6%. And for the government, that may be. But the government can only run a deficit if the private sector makes a surplus, because all the sectoral balances balance to zero. And there's a very clear chart in the recent article that explains that. And there is a very good reason for that. And it's because as everybody saves, private sector tends to save all the time because we're always saving for things in the future, for retirement, for a new car, to pay school fees, whatever. We're saving, we build up. And at the moment, we've been saving fairly record amounts, over 10% of disposable income, which is fairly high. Now, what you can track, if anyone wants to look at this, up to 2008 and the financial crisis, the private sector is not saving very much at all. They're leveraging, they're borrowing. And guess what? In that situation, the government doesn't run a deficit. In fact, under Blair, they ran a small surplus one year. So the government is always the balancing factor here. And this then goes back to when the government's running a deficit, it generally means people are saving. If people are saving, they've got to put their money somewhere. That means there's always a demand for government bonds because people want them. So the only time you really get a crisis with gilts, government bonds, UK government bonds, is when the country's supply side gets badly damaged, which sort of happened in the 70s. And when that happened and productivity drops, then the output is not great and you get a nasty outcome. But there's no sign that we're going into anything sort of similar to that in any way. And if anybody wants to know what it was like in the 70s, as I cut my teeth then, I'll tell them, and I can tell you you're a lot better off today than you were back in the mid-70s.
Just digging further into that, just because I think the biggest mental hurdle for me to understand your deficit, government deficit and household savings is how does me saving an extra 1,000 in the bank, for example, mean the government is less 1,000? How does that work?
So if you are going to save, someone has to take your money off you. Mm-hmm. Otherwise, you've got to, whatever you've got as a surplus, even if you've got cash, that's lending the government money. So in actual fact, because we count everything in money, you're saving whether you like it or not. If you're building up a surplus of cash, of notes, you're saving. If you're putting it into a building society, you're saving. If it's in your bank account, you're saving. If you buy a government bond, you're saving. And any one of these, the money has to go somewhere. So at the very least, if the Nationwide can't lend it to somebody because they don't want to borrow it, they'll buy government bonds. So almost savings will always equal total investment. And this is why the government is actually always a balancing factor. Now, interestingly, this still doesn't get appreciated. But you go back in the US to sort of, we've had debt for centuries. We understood the benefit of debt. Debt is a good thing. It enables the economy to function in a much better way than it does without it. When Alexander Hamilton was sort of setting up the framework for what was like the Fed back in the 1780s, he understood that debt was good. 1780s, 1790s. He knew debt was good. And effectively, America more or less followed what he set in place. You can't, if the government refused to borrow, the economy will grind to a halt.
So why do they always blame the previous government for a good thing?
Because people listening to this are probably, some of you are thinking, what on earth is he going on about? So the economics, it's not an easy story, is it? No. It's like somebody trying to explain to me nuclear fusion. You can explain it to me as much as you like. I won't get it. It's not my field.
Government debt's just big, bold lettering.
Yeah,
that's how I see it.
Yeah, that's it.
Because it's reported all the time.
But what will make you feel better is if you look back over centuries, there's always somebody saying debt's too high, debt's too high. We shouldn't have any debt. Even 30-40%, sometimes people think it's too big. So, but it doesn't work like that. Because you save, you're more economically active. You will take more risks. You will do stuff. If you haven't got that ability to save, if the government doesn't run a deficit, the system doesn't work properly. The next question should be, if you're thinking about it, is then how does the government debt to GDP not go to infinity?
I've always thought that.
Yeah. So it goes up, but people love the big headlines, don't they? You know, in fact I put one in the article, didn't I? I said it's gone to.
That's always the last government's fault.
Yeah, that's it. That's always the last government's fault because it's an easy story for a politician.
Yeah.
Does the politician want to get in front of you and explain 300 years of financial economics and why debt to GDP is a good thing? People are going to switch off and they won't vote for them.
No, because it's perceived negatively, it's almost as if governments use it to retain being the favoured party in power.
Yeah, it's always the last party's fault. And that's not new. It's always been like that. But the difficulty is that there's an old saying, isn't there? Every government, every party knows knows the solution to the economic problems. They just don't know how to get elected if they tell people the truth.
So if you were running, what would your message be?
I would tell people I'm going to make them better off because it's easy. So easy to do. You make them better off. Just tell people you're going to make them better off and make them better off. I'd rather we got people doing something with their own cash. And in my view, people are much more efficient. It's much more efficient, much more economically productive for get families and businesses spending their own money than getting the government to do it for them.
Sure. Yeah, enjoying it. Moving slightly away from the politics side, but speaking of all this that you've seen and learnt through your time, what lessons from history do you think that investors most overlook?
Cycles repeat. Anytime somebody says it's different this time, be very careful. The bubbles tend to really expand just before they go pop. But the big thing I would say to anybody is don't invest your money to get the highest return. Invest your money to do what you want to do in life. If you focus on that, you take a completely different set of decisions because you don't get sucked in by FOMO, fear of missing out, and you make sensible decisions and think long term. So they're the two key things. Invest your money for what you want to do, think long term, and that will keep you out of a lot of trouble. Difficult when, it's difficult when people are making more money in other things, racy things that they're doing well with. But what does it matter?
Well, I thought you mentioned bubbles. There's been a lot. We've talked a lot about AI and the Mag 7, and that seems to have quietened down a bit. I'm not sure whether you're hearing less.
Well, it did quieten down a bit at the start of the year, and it's come back a bit more now. So I'm on a knife edge as to whether my prediction's right.
Of course.
By the end of the year.
Of course.
Having said that Mag 7 will underperform this year. So it's touch and go, Leo. It's touch and go. I might be eating a lot of humble pie at this upcoming seminars. Yeah.
But the gilts are safe.
Gilts are safe, yeah. Gilts are fairly safe. I mean, inflation can rip the living daylights out of them. That's what you have to be careful. But that's why, in a cautious portfolio, you hold some equities and real assets. The price will respond to
diversify.
Inflation. You diversify. Diversify is the only free lunch in financial sector.
Do you see gilts evolving in the future, to mitigate geopolitical uncertainty?
That is a very, very good point, because we've actually been very innovative in this country. So one thing the government did years ago when people got spooked by inflation eroding the real value, we issued index-linked gilts. That was very clever. I think one of the possibilities going forward is you get bonds issued for specific funding, giving people a chance to put money into what they want to put money into. And then it'd be a bit of a test as to what the public wants to get going. Yeah.
Quasi-voting.
Yeah. Do you want to, this is going towards this, you can have that security on this, do you want to do it? There is a sense in which that does happen because infrastructure sort of has a relationship with the government. It's like private sector government link, where the private sector builds something and the government pay for it over a period. And we've got quite a lot of exposure. 9-10% of the cautious portfolio is invested in infrastructure. You get terrific yields there, and we've been using that to kind of damp volatility down a bit.
How liquid is infrastructure?
It's not as liquid and gilts are extraordinarily liquid. Infrastructure less so. So we would have to be mindful about how much infrastructure we held in a portfolio. But we do our research thoroughly, and you want to make sure it will continue going and paying out dividends.
Yes, you talk about the 60%, 40% in the cautious, and that's not something that you just pick up and put together. You have to maintain that, don't you? You have to be watching the stocks that you're invested in, because that might move and shift.
Yeah, we watch it all the time. There's a constant, there's a bi-weekly meeting to look at all the equity positions that we're sitting on. There's a monthly fund management meeting where we go into a bit more detail. And as you can imagine, there's a lot of stuff going around the team all the time on what's going in. Everybody's got their Bloomberg screens up looking at
risk
things.
Control. So quickly, if you could, what was the feedback in these meetings when you sat up and says, now I'm looking at bonds?
I don't think the rest of the team find bonds as exciting as I do. I think probably they're an old man's investment. So perhaps I've got to this age, I find gilts more exciting.
Was there any surprise?
There was a little bit, and I did put a piece round explaining why I thought that they were worthwhile. But remember, Leo, we were coming from a position where we were really not holding any long-dated gilts. Our duration, which is kind of the average holding period, was so of bonds. We weren't holding any 20, 30-year gilts back in 2022, which was an absolute blessing when that budget happened in August of that year. We didn't get caught out, which is why our relative returns in 2022 were fabulous compared to other people's. And that's when we got all the 6 awards. But it's changed. And now you've got to... And in a piece of me, because I went through the 70s, when gilts were thumped, they were thumped. You lost significant proportions of your value in that period. Nominal and real. In other words, the prices were dropping and what was left wasn't going to buy as much because of high inflation. And equities were a better deal then. But since 1990, it's been kind of we've had a sort of 30-year bull market in bonds, and culminating in their prices becoming extraordinarily high in 2020 and 2022. What excites me is, to me, they've gone back to normal, so we can start getting into them again. Makes my life a lot easier. You're not going to get too many. You're not going to get slagged off too much for buying gilts.
Thank you, Gary. Forthcoming budget.
Yes.
Any thoughts, predictions, things you might like to see?
I'm terrified.
Are you? Are you really?
I am, because if she knows better, because I don't go with this idea that she's economically incompetent. She's not. She's a trained economist, qualified economist. I thought that was a bit that's a bit arbitrary to actually accuse her of Rachel from accounts. It's not fair. George Osborne had a degree in history. At least she's got an economics degree. She got a master's from LSE, so she's smart. But I just think that Labour are going to have to resort just to try and squeezing the wealthy for more money. They'll probably freeze the allowances again, which is an easy way of increasing the tax net without you really noticing it. In other words, your tax-free allowance doesn't go up and hasn't been going up for a long time. And you take more money off of wealthier people, which is fine, but it's not a free hit. Because if that money is coming out from either wealthier companies, wealthier individuals, then they've got to take it out from something else. It's either invested somewhere or it's getting spent. And that will not happen. So it's not a clever way of trying to... If you're trying to get growth, this is not the way to do it. And it worries me that they'll just double down on the previous budget. And perhaps the best... I think within this country at the moment, the real opposition is the left wing of the Labour Party, who have stopped the cabinet doing a few things that they wanted to do, like scrubbing the winter fuel allowance. See if they're brave enough to break the triple lock, which is a stupid thing to introduce in the first place by the Cameron Osborne government. But that would be sensible. But I am bricking it as to what they're going to do.
Well, we will see, and we'll be reporting on that, won't we, Hazel?
Yeah, we will.
So, yes, if you're not subscribed to News and Insights from the Courtiers, please do visit our website and sign up for all our latest commentary. And again, if you want to read Gary's pieces, they'll be on the website for you to read at leisure. Thanks for listening. Gary, thanks for your time.
Yeah, thanks, guys.
Hazel, thanks.
Thanks.
Been a lot of fun.
Yeah.